Hello and welcome to our very special series Outlook 2017, where we are asking just a handful of experts what they think the next year is going to be. 2016 has been a year of surprises. Donald Trump, Brexit, demonetization, whatever you could have asked for or not asked for got pitched at the market. How will the market digest all of this over the next 12 months? My guest today on the show to discuss all of this is Ridham Desai of Morgan Stanley. Ridham, thank you very much for joining in. 2016 has been a heck of a year. I was reading one of your reports which was written just 2 or 3 weeks after demonetization, where you suggested that 2017 could be a year of double-digit returns for the market. Since then, a few weeks have passed. Are you feeling as confident about that forecast, more confident or less confident?
You can never be confident, Udayan. You have to remain skeptical. Such is, the behavior of markets. But let me go through the premise. That premise is still there, so I'm not changing the forecast. The premise is that equities today are trading at almost the same multiple as local long bonds, and that doesn't happen very often. The last time it happened was in the summer of 2013, when India got knocked on the threat of the Fed taper, and then you have to go all the way back to 2008. So in the last 8 years, you basically have had two instances. Now both of them actually proved to be very good occasions to buy stocks. Naturally so, because you could argue that India has a good long-term story in terms of growth, and therefore the cash flows from equities will far exceed the duration of cash flows from bonds, which is, the 10-year bond gives you coupons for 10 years, but equity coupons will continue beyond that. So equities should be more valuable than bonds. Now, this is the argument, and therefore I think it's the price that really attracts me. It's not the certainty of growth. In fact, if anything, I think the environment remains uncertain. And what it reminds me of is that the point of high uncertainty is also equal to the point of high return. So that's where the confidence, if any, comes from, and that's where the outlook is built. That I think we're heading into a better year for equity returns because stock valuations are far more attractive than they have been in a while.
What is the source of your uncertainty, Ridham? You did use the phrase that you're not sure as sanguine as growth, but valuations seem quite tempting to you. The source of uncertainty, would you say, is local because of the headwinds that we've got buffeted with demonetization, etc., which is making the picture very murky in terms of growth? Or are your concerns largely global in nature, the way the dollar is moving, which might present challenges for emerging markets, including ours?
So, Udayan, let me say at the outset that actually we are forecasting better growth next year. But then I have to also remind you, and I'm sure you remember, that when we had this conversation at the end of last year, we had a similar sanguine outlook for growth. And in fact, actually things started turning around. If you look at the quarter ended September, we've had the best earnings growth since 2010. And therefore it did look like corporate earnings were turning around, and then out of the blue came this demonetization move, which arguably has delayed the growth cycle between, say, 1 or 2 quarters. I mean, we don't know really. We don't know exactly what the impact is. And that is one area of uncertainty. So even with that uncertainty, we are still expecting double-digit earnings growth next year, because I think the trajectory had turned. India's growth environment was turning. And the big difference between what we are seeing now, in, say, going into 2017 versus the last 2 years, is that the external sector has got better. Global trade is off lows and is improving. And a quarter of India's manufacturing is exported. India does have some reliance on exports. Importantly, if you look at it just from a Nifty perspective, 45% of Nifty earnings come from outside India or are hinged to external factors. So this is actually a better environment for growth. Albeit, as I said, I mean, there is uncertainty regarding the depth and the breadth of the impact from the currency exchange, as well as you point out, from the US policy. Now, again, there, the sequencing will matter a lot. The incoming president has promised a variety of things, including corporate tax cuts, a massive boost to infrastructure spending, but also tighter trade negotiations. Now, how he sequences these things will be crucial to growth. So if he first goes for infrastructure spending in the US, coupled with tax cuts for corporate America, we'll actually see better growth. The trade negotiations may actually happen a little later in his tenure, and the negative impact of that may only be felt a little later. So that sequencing will also be important. We won't know this for the next quarter or so, and that's where the uncertainty comes from. But to be sure, we are expecting growth to actually be better than it has been in the last 2 years.
On the subject of demonetization, Ridham, are you confident that this will be a 1 or 2 quarter hit, or are your channel checks indicating that this is still in the realm of the unknown and there could be a few nasty surprises for the market?
So, Udayan, I would reckon that channel checks are not reliable. The nature of the event is unprecedented, and the channels are feeling very depressed right now. So if you just rely on channel checks, I think the feedback you will get universally is that it's going to be really bad. But these things can normalize quite quickly. The math that we've done is that we don't actually need all the 14 or 15 lakh crore back in circulation, because we reckon that a fair bit of it, maybe 30 or 40%, was stacked up in cupboards which was not actually being used as currency for transactions. So ultimately, we may only require about half to say 60% of the currency back for transactions to normalize. And I think that's a situation that we can envisage over the next few weeks. So going by that, I would imagine that activity in the economy will normalize more quickly than what channel checks are suggesting right now. But the uncertainty, I think, is about the aftermath. I mean, does this actually lead to small businesses suffering for a more prolonged period because cash transactions become more difficult to do? And India is a cash-intensive economy. So does that change happen so quickly that small businesses suffer, and as a consequence there is an impact on job creation and consumption? I think that's what we are not very clear about, and that only time will tell. But as far as just the currency in circulation is concerned, I think we'll have not normalcy, but normal-like conditions, I think, pretty quickly. I would reckon in the next month or so.
And a few months after that, we'll be probably hit with another disruption, Ridham, which is GST. You're sure that through the course of the next 4 quarters, the market will be able to deal with these 2 disruptions one after the other? The moment it starts to normalize after demonetization, it now then begins to fret about the changes brought about by GST. You don't think that will be earnings disruptive next year?
No, that also will be a problem for, I think, broad markets for smaller companies. I think larger companies may actually end up benefiting from GST. The timing of GST has also become a little less certain, given how the Parliament session panned out in December. And I think it's going to be a lot harder now to achieve the 1st April deadline. So more likely we are going to see a delay in GST. But GST is also going to be something that is down to execution. And we've been saying this to investors for the past year or so, that do not underestimate how complicated the execution is. We're talking about nearly 10 million firms coming online, 30 million digital signatures, and several tens of millions of transactions on a daily basis. If anything, it's actually more complicated than the currency exchange that has happened over the past 1 month. But of course, there is greater preparedness as well. There's no suddenness to this, so the system is, I think, far better equipped to deal with it. But we cannot take away the fact that there will be some uncertainty and some impact out of GST. Again, like demonetization, I cannot pinpoint exactly how much. And therefore, then we go back to the question on whether to buy equities or not. I think it's hinged on prices. I don't think we can confidently say where growth is heading, whatever my forecasts are, but I think I can surely look at share prices and say that it's looking attractive. And that's the reason why I think 2017 may pan out to be a better year for equities than say 15 or 16.
So what should a long-term investor do, Ridham, keeping 2017 in mind? Should he just go by what you're saying, that valuations have become attractive, Now, depending on how quickly markets or growth bounces back, you will see returns actually coming in the next 3 or 4 quarters, or at best it might get delayed. Should he work on that premise that the risk is that you may have to wait a couple of extra quarters till all these things settle down, and then you will get your returns? But if you buy at these valuations, it is only a matter of being patient, because the returns will come. The absolute downsides may not be very significant. Would that be a fair assessment?
See, I think time is always the friend of equity investors. So the investor who has the maximum time on his side also has the maximum return on his side. So whichever investor is thinking about equities, thinking short term is always fraught with much greater risk and much greater probability of downside. We can never be sure whether the markets don't have substantial downside or not. I mean, events could pan out very differently. I mean, I have to admit that, on the back of Brexit, we thought stocks will go down, but they didn't. On the back of the US presidential election result, I think a lot of people thought stocks will go down, and they didn't. So stock markets can be very funny animals, and therefore I would never hazard a guess in what happens in the short run, and can this go down before it goes up? It can. But if you have time on your side, I think it eventually turns out much better than those who don't have time. So yeah, I would agree with you. For investors, for long-term investors, these are good opportunities to engage in equities. You wait for that time when equities actually become cheap, they become less favored, they're not very popular now, and that's the time when you come in and buy, and I think eventually it works out in your favor. So I agree with you.
Time for a break. We'll return with Outlook 2017 in just a minute.